Hi, good afternoon, ladies and gentlemen, and welcome. This is Leonard Silverman from Congregation KJ speaking. I want to welcome in person those who are gathered here in our somewhat refurbished Heyman Auditorium, which was made usable in the aftermath of the fire for this academic year, and which will be rebuilt in its true earth form at a later time. I also want to welcome those who are joining us telephonically. I know that we have between those who are here in person and those who are on the phone, nearly 50 people representing 50 major organizations of the synagogue and the yeshiva day school world in this country. And we are very grateful to the OU for arranging for today's program as part of a year-long course of study, which is really what this is for executive directors nationwide. And it's wonderful that the OU is taking the initiative to educate and to acclimate executive directors so that best practices can be shared. You ask, so how do you make your synagogue or school safer? I would say, well, for starters, don't set it on fire. We are very much challenged by what happened on July 11th, and both the school and the synagogue communities have displayed exemplary forbearance and understanding and patience with the professionals who run those institutions as we quite frankly, struggle to accommodate the needs of the synagogue and the school. And we're very fortunate as a synagogue community. I'm here today as the synagogue's executive director. I do not work for Ramaz School, but I can say that KJ, the synagogue, would be sunk were it not for its sister institution, Ramaz School, which has thrown open the doors of its facilities and jumped through hoops to accommodate our synagogue programming and services to the extent that they do not interfere with the primary mission of Ramaz, which is to educate over 1,100 students. So that has been a great boon to us. As I continue to wallow in self-pity for all of the logistical nightmares that I have dealt with and will continue to deal with, I am mindful that in the greater scheme of things, what burned and was destroyed was merely a building, and no human lives were lost and nobody was injured, which is the most important thing to remember in any disaster situation. I'm particularly mindful of that as I sit here this afternoon proofreading our program guide for tonight's Yom HaShoah program, which truly represents for us here and on the phone and for all Jewish people a true disaster, and that affects us all, and that reminds us all of priorities in life and that which is a disaster from which we can recover versus that which is a disaster which lasts for centuries, because buildings can be rebuilt, but human beings cannot be so easily replaced, and Jewish souls are not fungible. So, with that sobering reflection in mind, I want to turn us back to the somewhat mundane matter, but nonetheless important, of how to best plan for, from an insurance perspective, a disaster. And today's presentation will hopefully give you some food for thought and cause you, we hope, to pull out of your file folders dusty documents that have been sitting there untouched for years, contracts that have been perhaps renewed annually on an automatic basis without much reflection. And we hope that today's presentation will generate some genuine discussion among professionals and lay leaders alike as to whether or not your institutions are adequately protected. So without further ado, it is my pleasure to welcome Mr. Michael Brooks from Austin and Company, which is the insurance broker for the K.J. Ramaz family. Michael.
Thank you. We appreciate everyone's hospitality and your interest in the subject that Lenny delicately described as mundane. But I'm trying to look at it through the perspective of one gentleman here present described that he just came from a root canal and is now going to an insurance meeting. So there's some perspective there. I'm not sure which is worse, but Lenny gave me some good advice before we started this program. And his 2 points of advice were, why don't you plan on talking 20 or 25 minutes, and then I'm sure we'll have some spirited questions afterward. So I'd encourage you, given the format that we have some folks here on the ground, and then of course some folks calling in, that we'll probably want to hold our questions till we get to the end of the slide. The other advice he gave me was the quick reminder that, Mike, you're the only one in the room that enjoys talking about insurance. So I'll be sensitive to that. I've purposely kept this a high-level conversation, knowing that it's hard to cover any of these subjects in great depth at a granular level in just 20 or 30 minutes. My hope is that you'll pick things out that I hit in my PowerPoint slides that you'll want to emphasize more, that you'll want more detail, and we can cover that through questions. I'm hoping that everyone can hear me very clearly, and we would have heard so by now, I assume, through the speakerphone if there's a problem, so I'll just keep going. For those of you in the room, our projector seems a little bit challenged with some of the color palette that we selected back at the office. So I'd encourage you, you may want to follow along in the PowerPoint handout that we gave you in the packet a moment ago. There's also a few other documents in that packet that I'll speak to in a few moments. And for those of you listening in, it may be challenging for you to stay with where we are in the PowerPoint. So at a few points, I'll just stop and tell you what screen I'm looking at so that you can catch up. So if we click forward just a bit, the first screen, as we click into it, has our logo, Austin and Company. Lenny's other warning to me was, don't turn this into an Austin and Company pitch. So I'll limit myself to one screen and just a few bullets. The short version of those bullets is that we're very much a boutique insurance agency. We are not a generalist firm. We wouldn't, for example, know what to do with insuring a retail store or a trucker or a manufacturing plant. Almost all of our client base and almost all of our revenue comes from not-for-profits of some sort. Often they're those that have some tangential relationship to education, K through 12 schools, and their affiliated religious organizations, colleges, those types of things. And there's a special craft that goes along with insuring a not-for-profit of any type, and in particular, those that are a house of worship of some kind. And we have a specific set of credentials because we've had decades of experience focusing on that client base. That's relevant in a few ways that I'll speak to further in the presentation. But if we click forward to the slide entitled Risk as we define it. For the purposes of this discussion, we won't be addressing investment risk or any of those type of reputational risk issues, although those are certainly weighty. Our focus will be around more traditional insurable risk. For example, we can all understand or identify with in our personal life if you have a home or a condo or a co-op or what have you, or even a vehicle, you have a physical asset. And if that asset is damaged or destroyed or stolen, there's some economic impact, some economic risk to you. The other component of risk as we define it in our industry relates to liability. That's an example where some other party pursues an action or tries to hold you legally liable for causing some type of injury to them, whether it's reputational injury, whether it's bodily injury, whether it's damaging their property. Keep in mind in this context that that allegation or that legal liability does not rest just with your employer, quote unquote, or a corporation. it can rest with individuals within your institutions. For example, board members have potential personal liability because of their relationship with your organization, and potentially an employee or a volunteer can also. If we flip to the next page, and this did not survive the projector very well, this was an attempt to speak to the issues of how you would handle those risks, those property-related risks or liability-related risks. Again, for the context of our discussion today, there's two avenues or two directions that are constructive to think about. One of them is to transfer that risk. When you buy a homeowner's insurance policy, what you're basically doing is giving some money to an insurance company, and they take on the risk of your home burning down. That concept of risk transfer is an important one, not just in the discussion of insurance, but in contractual relationships. One of the important diligence points that we spend a lot of time working with Lenny and a lot of his colleagues here on is contractual relationships with other parties. The general contractor, for example, rebuilding your property, or your contractual relationship with your architect, so that they take on a fair portion of the risk from those operations. The other component, and an area we'll spend a lot of time on today, is how you can prepare to react and respond when one of those risk events or exposures happen. So again, the guiding themes when you're addressing a risk or a concern is one option is to transfer it to someone else, which you do through insurance or other relationships, or how you can prepare to control and react to that risk if something happens. The next page looks a bit like a solar system or a planetary system of some kind. What we're trying to address here, what we're trying to convey, is that a house of worship, just like many not-for-profits, kind of scare the heck out of the insurance industry. Because there's a cluster of risks, both property risks and liability risks, that are essentially unique and are very hard to quantify and to underwrite. The parallel I give a lot of folks is that if you opened up a florist on Lexington Avenue today, in New York State there's in the ballpark of 200 to 300 insurance carriers that could very easily insure you. The Travelers, the Chubbs, all of the big nameplate companies, even the State Farms, could insure that florist and give them all the coverages that they need, and you could buy that coverage as the proprietor of that business from thousands of agents, insurance agents within the 5 boroughs. And out of that 200 or 300 insurance carriers licensed in New York, if all of a sudden you're a not-for-profit, how many of those can insure you adequately and correctly? That narrows down to a dozen or less. So it's a very different marketplace because of the things you see on that screen that describe your liability risks and your property risks. And let's talk about those for a moment. There's business activities that a house of worship is involved in that frankly keep underwriters awake at night. You deliver counseling services and, in a sense, psychological or professional counseling through your clergy and other staff in a way that almost has a medical malpractice component to it. There's a specialized coverage that has to address that obviously the florist on Lexington Avenue doesn't have to worry about. You have athletics and teams and physical activity on the scale of which that most for-profit businesses never would. You often have a school or a lot of young people involved either in a weekend program or an out-and-out school operation like Ramaz. Transportation and travel activities, and a cluster of other things. So if you gave me a half a day, I could fill that page with things that are unique to a house of worship that most for-profit businesses don't have to worry about. Now, because the scale of that conversation is so big, and because, frankly, I'm here as a result of the fire that KJ had, we're not going to spend any time on those liability risks. I'd certainly be happy to come back, and if you had enough caffeine, talk about the liability side of the equation. But the context of our discussion today will be the left side of that screen, those circles that speak to property risks. And again, in the same way that a house of worship has liability risks that are unique and troubling, a house of worship also has property risks that are just as unique and a concern to insurance underwriters or to risk managers of any sort. I've put a few up there that are worth a moment of conversation. I'd venture to say that most of you have a specialized valuation to think about. In other words, your building is not just a traditional concrete block office building, that you would build another one of them in a moment. You can define exactly how much it would cost you to build it, and the materials and the skills to rebuild it are readily available. Those comments are not usually true of a house of worship. There's some specialized coverages that need to address some of the specialized physical plant that most of you have. Unoccupied buildings. In a traditional house of worship, many hours throughout the week, that building is empty, or large swaths of that building are empty and not being used. That is a textbook example of how a fire is more likely to happen and go undetected as opposed to a traditional retail space. Add in the layer that most of you operate a restaurant to some degree. In other words, you have cooking facilities. Sometimes they're state-of-the-art, well-controlled, and well-policed. Sometimes none of those things are true. And judging by the laugh from a few folks, often none of those things are true. Historic buildings. Now, what that means in the layman's terms, well, that's a very appealing historic building that's an important part of our culture and history. In insurance terms, what that means is you're not complying with any of the codes that we think are important. So there's a lot of issues within that property context that make you a concern to the insurance industry, and it should be at least an awareness issue. Part of the goal of hitting these points.
Gary, you had to turn in papers to the office. Sorry to interrupt. Could you ask the folks to mute their system? We're hearing someone in his office. It's very interruptive.
Please mute your phones.
All callers are muted.
Okay. Hopefully you're still on the line, but you're muted, so I can't tell. Again, the goal is not to, quote, scare you with any of these points, but to make you aware that there's a cluster of risks and hazards unique to your businesses that most operations don't have to think about. Most for-profits don't have to think about. And because those operations are complex and they vary so much from one house of worship to another, the insurance industry sometimes says that this is too much for us to underwrite. It's very hard to quantify and price for correctly, so we're not going to participate in that marketplace. That gives you narrower choices of how to buy your insurance, whom to buy it from, and how to structure it. So it takes a more informed hand, and it's more of a craft to put your insurance programs together than it would be for that florist that I'll keep picking on through our meeting today. Let's move forward to where we have a picture that's a little saddening to all of us in the room, and that is the photo from the night that I received the call at about midnight, I'd say, which was, on one hand, a very sad and emotional moment. I believe that call came from Benji Brown, who's not in the room with us today, but the tone of it was him breathing heavily as he was running up the street telling me about the number of fire trucks that had just pulled up at KJ. And my first feelings were a stew of empathy and concern and what's my next move and how do I do the right thing for the customer. But I'll admit there is a moment of, okay, I feel good, especially once I've learned that no one was injured. And that became clear, it appeared to be clear very early. And the reason I felt, quote, good in the professional sense is that we had worked intensely with Ramaz and with KJ to make sure that their insurance program was ready for this. I'd be hard-pressed to think of in my decades-long career in insurance, and almost all of that is in the not-for-profit, large commercial circle, I'd be hard-pressed to think of a client that was willing to spend more time and effort on the subject than KJ and Ramaz. And that has paid dividends, both literally and generally, to both organizations. There was a solid balance, as I put it, of good insurance choices, real agility into how they reacted, not just in the first few hours, but in the first few weeks of building recovery strategies, doing that initial triage, and minimizing the pain, is how I'll put it, because there is a cluster of pain that goes with a disaster like this. I think we can all identify with the emotional pain that if you're a member of this congregation or if you're a member of this community in any way, to learn of the tragedy was a painful moment. But there's a whole other set of dominoes that happened downstream of that we'll spend a minute on now. I described it as a tragedy that was well handled, and that's a bit of an oxymoron, I know. But let's talk about what KJ did right, very right, in my opinion. One is that intensive and ongoing review of their insurance program. I would probably have 2 to 3 meetings per year with the senior staff of the school and the congregation on one subject line within the insurance program. Now, in truth, most people, especially board members, spend a lot of time emphasizing those liability risks that I just talked about. That's important and very understandable because A, it has a catastrophic implication to it, and B, there is that personal liability component to think about. You can have a board member lose their house if the insurance isn't structured correctly to defend them. But there was also a lot of intensive effort and discussion around the property insurance and how that was built. I can't tell you how many times I explained what business interruption insurance is, how it's used, what it pays for, and how you go about making an informed decision of how much of that to buy. And I'm smiling when I say that because I usually can't slow a client down long enough in a meeting to actually listen to those explanations. It was refreshing and a bit surprising over the past years of getting those kind of drill down questions all the way up to including the board level at KJ. There are people that sat on your board, Lenny, I think you'd agree, that made it a priority for them to understand in great detail how the insurance program was structured and to have input into some of the decisions about that. The other component around it, again in this direction of property insurance, was appraisals. Most of our client base struggles to tell us what their building is worth, what their physical assets are worth. And as we'll spend some time on in a moment, that is not the book value or the depreciated value you might see in a set of financial statements. Insurance largely speaks to the issue of what will it cost us to rebuild or replace. The way you get that answer is appraisals. There was never any doubt when I hung up the phone that night that KJ had the right amount of insurance to cover their physical assets because they had done periodic appraisals, not just of their building, but of some of their fine arts, Torahs, things of that nature. And we had all of that documentation on file. So there was never a breathless moment where anyone said, this is a $100 million building and we only bought $50 million of insurance. That was a non-issue. Emergency planning. We'll spend a little time on that as we get into some later slides. But Ramaz and KJ had the framework of an emergency plan, at least knowing where they would go and what they would do in general terms. Because it had come up. There had been discussions, strategic thinking around that subject. And finally, and this is one that's routinely overlooked, is vendor relationships. The moment you have a catastrophe like this, there's certain vendors that become super important to your recovery plan. And I don't mean your insurance agent or your insurance carrier. Other parties that you'll need to contract with right away, and we'll spend a few minutes on that. KJ and Ramaz did all these things extremely well ahead of time and as the disaster happened, and reacted in a way that you would grade them as an A in each of those checkpoints. Okay. Disaster planning. I know that some people would like, say, our firm to produce for them because they're a customer, a disaster plan or an emergency plan. The truth is, to do that right and to do it in a comprehensive, granular kind of way is frankly beyond the scope of our firm, and I would offer it's beyond the scope of everyone in this room and on this call. The parties that do that and do it in the way that I'm about to describe to you, maybe some Fortune 500 companies could devote the resources to it to do it. Colleges like a Columbia or an NYU have a full-time vice president level risk manager, and even they struggle to have a real detailed, granular recovery plan. That's not to say you can't have an emergency plan. In other words, what you're going to do in general terms in the first 3, 24, or 48 hours after a catastrophe, sure, you can write that out in a lot of communication types of things. But as a bullet I've put up there describes, there's this concept that generals like to talk about of the fog of war. That the best battle plan, the most detailed battle plan that's ever drawn up by the US military, who loves to plan, as you know, goes right out the window the first time a few shots are fired. And it's about improvising and adapting downstream from that moment. So what I think my conviction is that a more realistic approach, unless your organizations want to go out and hire a full-time risk manager to build a binder for you that's hundreds of pages long and addresses every single contingency example, the more realistic approach is to have a very finite response plan for that first 24 or 48-hour window, and that would include some communication pieces, some emergency sheltering kind of pieces, those kinds of things that we'll talk about in a moment, but to have a more general roadmap. And I have some tough questions for you in this to help build that roadmap so that you can start working in an improvisational way in the days that follow a disaster. It's not realistic to think that you could have a detailed plan for every single portion of your building, or if you have a campus setting, that you would have a response plan and a backup facility for each one, because those are all moving targets. You'll see what I mean in a moment as we move through this. So, if it were me, and if I were in your chairs, what I would do is what are called in our industry quick hits. And that's an example where you can have a big impact in terms of emergency response or an emergency planning with a modest investment in time and resources and administration. And the focus to those quick hits would be on the things that you know, the things that you can control. The parallel I'd give you is if KJ 5 years ago had tried to do a very detailed emergency relocation plan, and it said, all right, if we lose our whole school building, here's where we're going to go within a 5-mile radius, and here's the properties that are available for rental, and we're going to go out and sign contingency leases on those. Is it realistic to think that all of those spaces are still going to be there 3, 4, or 5 years later? Probably not. But could you have at least a framework of vendors that you would use to help you do that and to search for those spaces when it does happen? So that's an area where you can control and still leave yourself room to address all the variables that you could build for every scenario. So that driving theme of adaptability and agility, but within a general framework of what you want to do. In the insurance industry, carriers have underwriters, people that decide upon who they're going to insure and at what price. And there is a whole workflow built around that process and that decision making. In recent years, the move has been, instead of hundreds of pages of forms and checklists to make that decision, to make each underwriter start with a blank piece of paper and write out their thoughts and notes, and that serves as the file. That's the parallel I'd suggest to you here. That when you go back to your desk, if you can devote 1 or 2 hours over the next couple of weeks to writing down what we would do if we had a disaster like KJ, literally starting with a blank piece of paper. And there's a few concepts within that piece of paper if you quadrant it off in a way I'll suggest in a moment. I think that is a realistic goal. I think it is an unrealistic goal to have a very detailed, hundreds of pages long risk management strategy. A, because it doesn't have permanency. B, because it requires a very specific expertise. And there's too many unknowns and variables. So, Disaster planning, again, as you go through that blank piece of paper, as I suggested. Insurance, we'll get to a whole separate discussion about that. Let's jump to bullet number 2. For everyone listening in, we're still on that page entitled as quick hits. Point number 1 was insurance, and then here we get to these real practical suggestions. Number 2, pre-arrange and pre-screen your vendors. I think Lenny would agree that all of those vendor types touched KJ and Ramaz within hours of when the event happened. And the fact that you had some of those vendor relationships in place that you felt good about saved you days of crisis management. An example would be there happened to be a general contractor that the organization was engaged with in a pretty sizable construction project that was going on. So it was a quick and easy default to have that GC start doing some immediate repair and triage work, even if they weren't the long-term solution. Even if you don't use them to rebuild your building when something like that happens, to have the name of 1, 2, or 3 GCs that perhaps you've pre-screened, pre-interviewed, talked to them about their response capability. Those kinds of relationships are critical. Another one, if you've ever had a fire or a furnace damage or any of those things in your private life, you know that your homeowner's insurance pays for a restoration or cleanup company to come to your home, literally to scrub the house, rip up the carpets, do the demolding, those kind of things. There is a whole industry out there of these cleanup and restoration companies that have warm relationships with the insurance carriers. And it would be easy for you, through a quick vetting process, including talking to Lenny or anyone else that you know that's had significant claims in the past, to perhaps interview a couple of those firms and have their name and contact information. They, along with every other vendor that you see on that list, starts to deluge your organization within hours after you have an event like this. We were having attorneys calling our firm, Austin and Company, saying, we're the attorney for Ramaz and KJ. We want to come and meet with you. They had never spoken to KJ and Ramaz. I can't tell you how many phone calls went into different levels of KJ and Ramaz wanting to be their GC, wanting to be their cleanup and restoration company, wanting to handle temporary transportation needs. That's not something you want to be triaging the day after you lost part of your building. In a more ideal world, you'd have those preferred vendors on that blank piece of paper I talked about a moment ago. And it should be a simple matter over time to do that through a vetting process of speaking to someone like Lenny or people that have had these kind of issues before. Same would be true, there's another category of vendor that makes me smile a little bit, and that's public adjuster. I don't know if everybody in the room and on the call knows what those folks do, but they're a fee-paid consultant. They get a portion basically of the insurance settlement you get. They don't work for the insurance industry, and there's sort of a good and bad news there. From our view, the bad news is sometimes they can elevate the discussion between the insurance carrier and the policyholder to an adversarial one, but that has evolved in that the better ones, the better public adjusters, most of their contribution is administrative support for you. If, for example, KJ and Ramaz had had to pull together all of the documentation on their own to process and adjust this claim, probably safe to say you would have to add to staff significantly to be able to do that. That's what these people do, and that is a good impact. That's a positive outcome. And the better ones have good rapports and good dialogues with the insurance industry already. It is not an immediate adversarial, rip their throat out kind of mindset. So that again is a vendor that would be worth pre-screening, even if it's a brief conversation with a few of them, so that that blank piece of paper, that blank page emergency plan that we're talking about, includes a few contacts for you. Number 3, a quick hit that is often overlooked. Has anybody at your organization thought about, or at least started the dialogue of, if we lost building X, or if we lost X portion of our main property, do we want that property back? In other words, are we really going to rebuild something that looks just like what we have? Have we at least wrestled with the philosophical choice of, we'll take our money and we'll go rebuild 2 miles away? Have we thought about the philosophical choice of we want to rebuild a building 5 times the size of what we have now? Those are decisions that are very hard to make on the fly, downstream of some catastrophe. If you at least start that dialogue now, or even if there's a planning committee thinking about it, it saves droves of work and frankly a lot of friction between you and the insurance carrier downstream of that catastrophe. Add another layer to it that you usually can't rebuild the building that you, quote, have now. There's code or other issues that usually prevent you from doing it. The other thing, again, still that blank piece of paper, things you can do as a quick hit. You can reach out to partner organizations, rival organizations, other houses of worship, and either in a handshake way or in a formal way, have a reciprocal with them, where, and many of you I know have this now, especially those of you at schools, that if you had a lockdown situation or you had a security situation and you had to evacuate all your students in the middle of February because of whatever the situation may be, you can go to a school across the street or a school within walking distance. That's great. That's a good response or triage approach, but have you thought about extending that relationship so that you could share classroom time or somehow share staff even if you're going to be out of your building for 6, 8, or 12 months? That's the kind of thing that's very hard to lock down into an actual contract, but if you at least start that dialogue and you've mapped out a few of those spaces, that's a real lifesaver. We're on to quick hit number 5, communications. Most of this work can be done ahead of time. For example, I am sure there is some wordsmith within your organization that could put together a script so that the chairperson of your board, within an hour of the event happening, could be on a YouTube video briefing all the members of your congregation or your organization about what has happened, talking to them about what your email and communication strategy is going to be, and making everyone feel like they're going to be part of the recovery and reconstruction process. It doesn't cost you anything to do that, to have that script ahead of time, or at least a framework of it. And it doesn't cost you anything to put that on YouTube. Same thing is true of, have you asked yourself, if you lost your building today and you needed to get information out to your entire congregation, your whole workforce, all of your employees, and your whole volunteer and board populations, can we do that if we don't have our servers? Probably. And if you don't have that capability now, it's relatively easy to buy that capability. There's a lot of vendors out there that will give you off-site redundancy in a way that you can go to somewhere literally within a mile or two of where you're located and start operating as an office right now. There's plenty of people in the for-profit world that have those plans up and running. And one that I hadn't thought of, the coffee factor. As Benji Brown over at Ramaz likes to say, that the facilities people at KJ and at Ramaz did a great job of buying coffee. And they bought it for the right people. The firehouse up the street, the cops in the neighborhood, and there was a dialogue and a relationship with those people. I'd offer that each of you in your chairs, maybe once a year, should stop in and talk to those people and have some rapport or dialogue. They're pretty critical relationships if you have an event like KJ did. That's a quick walkthrough on the disaster planning part of the conversation. I'll go even faster through the insurance part, but I don't hear anyone snoring so far, so that's a good sign. Quick thoughts and points on this. Specialization. As I talked about, you're not florists. Anyone can insure a florist. Not everyone can effectively insure a large not-for-profit, especially if you're working with children or if you have a large specialized property. Carrier choices. This is an easy one in that there is a minimum bar, in our view, that every carrier you do business with should have to get over. Your lender would almost certainly agree with these kinds of minimums, if not even hold them higher. First and foremost, AM Best, which is sort of the gold standard of rating insurance companies, assigns a letter grade to every insurance company according to their balance sheet, reputation, and a few other issues, quote, their ability to pay claims. I can't think of a reason why a large, sophisticated not-for-profit would ever do business with someone lower than an A-rated company. More ideally, that should be A or higher, meaning AA or A++, etc. It is uncommon for a lender to be okay with you choosing to do business with, for example, a B- company. The other component, if you're listening from New York State, the New York State Insurance Department does, frankly, a very sound job, even though there is no insurance department anymore, it's the Department of Finance, because they combine it with banking. But the insurance department does a sound job of stress testing the financials of insurance companies. It is very uncommon for an insurance carrier in New York State to be, quote, licensed and admitted by the insurance department and to out and out fail. It's almost unheard of. So as an absolute minimum, you wouldn't want to do business with a carrier that, for example, was a B- and labeled as non-admitted. There's no compelling business case to do that, price or otherwise. Valuation. This is another easy thing you can do, and you don't have to do it often, so that there isn't that Monday morning quarterback of how can we only have half the amount of insurance on our property that we should. There's plenty of companies that do a great job of insurance appraisals, and you can hire them to review your property and to give you a lengthy report that says here's how much you should be insuring it for. There is a strategic choice that would take a long time to explain here of whether you want to insure it on replacement cost, functional replacement cost, or actual cash value. If someone wants to drill down into those in the Q&A, I'll be glad to, but it's a little time consuming. Fine arts. This is an area where you see the most friction between the insurance industry and insurance buyers about how much a painting, a Torah, stained glass, artwork, etc. was worth after the claim happens. An appraisal largely makes that debate go away. If there is an appraisal, and for example, we had in file an appraisal on all the Torahs and artwork within the building we're in now, and that's shared with the insurance company, and they write the information right into the policy, it's pretty hard for that to turn into an ugly friction point between the parties. Ordinance and law coverage. I had mentioned that example of would we rebuild our building? Well, frankly, you probably can't rebuild your building. Even if you want to, the local codes and building enforcement won't let you put the same building up that was built 20, 30, much less 100 years ago. So there's a whole code compliance part of this discussion. Sometimes in a large building, you need an outside consultant to give you an informed opinion about it, because insurance, as most people buy it as replacement cost, pays for you to get the exact same building you had. And unless you have ordinance and law, or sometimes called building ordinance coverage, it does not pay the cost of those upgrades, which can be very substantial if you have an old building that you would be paying out of pocket. Deductible choices. That should be an annual conversation, probably up to a board committee level, in deciding how much, in other words, the limit of insurance we're going to buy, and what deductibles we should be using. How much risk can we tolerate ourselves? The first $1,000 of a claim, the first $100,000 of a claim. That's going to vary according to the type of insurance and the size of your organization. But it is usually time well spent so that you're not, quote, buying too much deductible or buying too low deductible. Liability insurance is a long, involved, and separate discussion. I won't spend time on it, but be aware again that that is just as difficult to buy the right program as the property insurance we talked about. Business interruption coverage. We're nearing the end, folks. If you look in the packets that were distributed or in the emails that were sent out, you'll see a couple of attempts by the insurance industry to help you decide how much business interruption coverage you should buy. And that's from two big nameplate A-rated carriers that specialize in not-for-profits, frankly. If you were to complete those forms, one from each company, you'd get to completely different answers, staggeringly different answers. So that's an indication of how hard that decision is of how much business interruption coverage to buy. First thing to remember about business interruption is you can't collect a dime of it unless you first have put in a property insurance claim. So the example being that if your whole congregation, if your whole school catches avian flu, or all of your employees quit and walk out on you on one day, business interruption insurance isn't going to pay for a dime of that. You need some sort of physical catastrophe. There's a whole labyrinth of how you structure that, whether there's monthly limitations on it, actual loss sustained, contingencies, and things that frankly would take a college professor half a semester to walk you through before you'd be comfortable. That again speaks to the issue of you really need to deal with a specialist to coach you through that insurance choice. If your vendor right now isn't someone who's very comfortable and well-versed in not-for-profit insurance, it's going to be a struggle for that person to coach you on that business interruption choice. One of the choices within that is going to be, how long do you want to pay your employees? If, for example, you operate an organization with 100 employees, your building burns down, and you're going to functionally close during the construction process, are you trying to insure for the model where everyone still gets a paycheck? Or is your approach going to be just a selected management team? Or is your approach going to be some reduced payroll amount because you'll have reduced operations? That's a conscious choice you have to make in the discussion. Some parting shots for you. Your trip to the dentist is almost over. Those of you who haven't been there already today. I think, and I know this sounds narcissistic, but I think the most important decision you make is who that agent or advisor is for you. Not saying that we're the only ones that can do it, but it is a small subsection of our industry that can do it right. That other guiding principle, there's a limit to how much you can realistically, all of you personally, can do to plan for a disaster or an emergency situation. And that time, in my view, is better spent preparing generally, brainstorming, that blank sheet of paper example that I gave you. The other part of it is, I know it's cumbersome, but to make this an enterprise-wide discussion so that there's board involvement, so that decision-making is spread amongst a few different heads being together all at once, getting other people to get some buy-in and devote some resources to it. I've always had empathy for the person that's a CFO of an organization, makes the wrong insurance choice, and is second-guessed after the fact. That's a pretty lonely place to be, because usually someone just lost their house, or usually an organization has an uncovered claim that has to be explained to a finance committee. That's a tough spot to be in, but if that finance committee was part of that discussion, that's not as tough of a spot. I can predict that if you make a lifelong career out of what you're doing now, it's nearly certain that between now and the day that they give you the gold watch and you retire, you're going to have some catastrophic event. Whether it's a major roof issue, whether it's a pipe break, whether it's weather related, or a fire on the scale of what KJ has faced. And then finally, has anyone ever seen an example where on a Monday morning, the New York Post tells Rex Ryan and the New York Jets what they should have done, and the New York Post is wrong? It doesn't work that way. Again, that quarterbacking the day after the claim happens is an awkward one. But on the other hand, it's a very satisfying feeling that I felt, I think Lenny felt, and I think others felt, that when you've done it right and the organization can continue to thrive, in some ways come back stronger, that's very satisfying. Those are my parting shots, and I think everyone's still awake, so I'll stop there.